Hey everybody, Greg Unthink here, eXp Realty Greg Unthink team. And if you're getting this video, you are a client of ours that we're actively showing homes to, or you're in the process of getting your loan pre-approved and are kind of in the preparation stage. And I wanted to talk to everybody about a couple of changes in what we're recommending for buyers in today's competitive market compared to the last year or two. If you've been out there looking or getting ready to look or keeping an eye on the media, you know that there's a lot of talk about how competitive the home buying market is, and I assure you it is every bit as competitive as you're hearing, and obviously if you've been out there, you're experiencing it. So the two major changes that we are making this year on recommendations to our clients is, number one, is how we're going in with the offer. In years past, we did mainly what's called an escalation clause, meaning we'd go in at the asking price and then build in an escalation number, or a number that the offer could go up to. This year, we're finding that it's better to go in with your highest and best offer in the beginning. We call it a shock and awe offer. And the reason to do that, and the benefit to you, is that it's going to get the attention of the seller, number one, but number two, a lot of times, especially if you have a government loan like a VA or FHA, just building in an extra $1,000 or two above the highest offer is not enough leverage to get the house, basically, if you're up against a conventional offer, let's say. Whereas if you're 5,000 or 10,000 more, then you've got a better chance of beating out that competitor who might have more of a conventional loan or a bigger down payment, something like that. The only time I would recommend doing an escalation clause this year is if you're really going to put some teeth into it and maybe escalate it to 5,000 or 10,000 above the highest offer. But for the most part, pick a number that's your highest and best. If you don't get it, then it wasn't meant to be, and we move on and find something else. But make that strong offer up front. Number two, on the subject of what's called appraisal gap coverage. And if you don't know what that is, it's an amount of money that's pledged up front by a buyer to cover the difference between a agreed purchase price and then what the bank might appraise the house for. And most of the time, the houses are going to appraise just fine, but sometimes they don't. But in almost all cases, in a fast rising market like we have now, the sellers and the listing agents are concerned about that possibility, because it is something that could happen as real estate prices have increased quite a bit over the last couple of years. So it's no longer who has the highest offer in the eyes of the seller. It's who has the highest offer and is the most likely to close. And one of the things that can kill the closing is the appraisal coming in low. So going in, a buyer's going to say, I'll offer $200,000 and I'll put up, say, $10,000. If that property doesn't appraise, that money can go towards that. So the seller now does not have to lower their price if the appraisal comes in low. You're taking care of that difference. Well, why would you want to do that? Why are you wasting money if you do that? Are you overpaying for the house if you do that? And most of the time, the way to look at it in a rising market or a competitive market is look at the job of the appraiser. And what the appraiser does and what they're assigned to do by the bank is to look at the past. They're going to look at what's been going on in the market in the last 6 months, last year. And in a rising market, those numbers are constantly changing and moving upwards. So the actual present market that you're in isn't necessarily accurately reflected by something that was going on 6 months ago or a year ago. It could, but it might not. And so the point being that appraisal is an opinion. It's one person's opinion in a very subjective process. If you send in 5 different appraisers, you'd get 5 different numbers. So that appraisal, although based on data, is not like etched in stone or handed down from heaven or something like that. There are other factors that come into play. So if you're offering on a home and there's 10 other offers on that property, you have plenty of social proof that that property is worth what you're offering. I can't tell you how many times I've had people call me that bought homes over asking price a year and a half ago, and at that time they thought, oh my gosh, are we overpaying for this? And they're calling me now saying, hey, I can't believe what my neighbor's house just sold for. What can you get for our house? So kind of the same idea. So back to the gap coverage itself. That money is basically additional down payment that you're going to make to cover that gap, and that's a good way to look at it. You're paying market value for the home, but you have to put additional money down to make the transaction work, so you get all the benefits moving forward. So where can that money come from? So if you don't necessarily have $10,000 that you can put up, let's say, for gap coverage, because it's a down payment fund, it can come from the same places that a down payment can come from. You can get it from your 401k plan at work, a gift from a relative. It can come from savings, stock conversions, equity line of credit, if you have a house that you currently own, anything like that. Let's say you don't have that though, and you want to create the gap coverage. You can convert funds that you were going to use for another purpose. For example, for closing costs. A lot of people have their down payment. They also know that you're going to need another 2 or 3% of that purchase price for the closing costs. In markets in the past, that's something that the seller might have been able to cover for you. In today's market, it's very difficult to get seller concessions for anything, including closing costs. So most buyers know that, and they have that money that they've set aside for the loan closing costs. Well, you can actually borrow money for closing costs. You can set up a line of credit with your bank or credit union to use for the closing costs. Now you want to talk to your mortgage loan officer about this, because there's going to be a little bit of a monthly payment involved if that strategy is used. So you want to make sure that that fits into your debt and income ratios. But you can set up a line of credit that you're going to use for your closing costs, and then take that cash that you were going to use for the closing costs, and now you can put that up as additional down payment for the gap coverage. So gap coverage, probably almost a must-have in this market. And if you want to talk about this more, you can put a call on my schedule. I put a link down on the video below. I've also attached our toolbox that goes over all the different strategies, including the 2 I mentioned, to help buyers to be more competitive in the market today. So call me if you have any questions. Put a call on my schedule. Talk to the team member that you're working with as well. And our hope is that we can make you as strong a buyer as we can in the market today. So call with any questions. Thanks for watching this, and best wishes in your home search.